Well, let's talk about the stock market and the broader markets. Major indices coming off their best day since the day after the election. Stocks jumped following a cooler than expected inflation data. Join us now, Mark Newton, Fundstrat Global Head of Technical Strategy. And you're fairly constructive, I think, Mark. But your one concern is breadth. And we talked earlier with someone about perhaps interest rates either staying where they are or at least not coming down, which is not great for the small caps. So I don't think there's no relief in sight for you.
Yeah, thank you, Joe. Happy New Year. Breadth did get hit very hard starting last fall. We saw declines in healthcare. Just in the last month, we saw really 7 sectors lost more than 4%. So, the percentage of stocks right now above their 50-day moving average is down to about 25%. So it has been a very hard-hit market in the last month. The one saving grace is that technology, to its credit, came back and actually has helped the broader indices remain afloat. So long-term trends actually remain in very good shape. It's more just near-term breadth deterioration, as well as I think sentiment has also gotten abnormally, pessimistic regarding the potential plans for, the president-elect's policies, which many of those we don't even really understand the extent to which that could be inflationary, and there's a lot of forces that go against that. What actually happens,
yeah, what becomes law or is actually done. But it still seems like you're saying, look, the indices are holding up, even though if you lift up the hood, what's going on is not great when you look at the detail. You still like 6650 for the S&P, though?
Well, it's just January. That's my year-end target. I do think that's going to be hit. Interest rates have gone up for reasons I think that many don't understand. Some of those have to do with longer-term Treasury supply and the incoming Treasury Secretary's plans on potentially funding some of this debt in longer Treasuries.
Yeah.
So these things aren't necessarily. We saw yesterday by the CPI data that wasn't necessarily inflationary. I think that's in the rearview mirror for the Fed, honestly. So the reasons why Treasury yields have been spiking don't necessarily have anything to do with what the common narrative is. My view is that rates are going to start to roll over in the months to come. That should be bullish, just given the recent correlation. Treasuries and equities have been moving almost in unison, and so I think that is going to continue for the time being. All equity, investors need to be concentrating on what's going on with yields, more so the velocity of yields. If they were to spike above 5%, that would be a short-term concern for the market, but we haven't seen, substantial trend damage to think that any of our upside targets that we set last month are going to be derailed.
We've had other guests on just today that almost said things that were in direct opposition to what you just said. Expecting inflation either to stay sticky where it is or even move higher, potentially. And for interest rates to at least stay where they are, possibly move higher. You think the corollary, or you think the other situation happens?
I think things are a little bit overbaked with regards to yields having pressed up.
And inflation, too. You think inflation is under, you said that it's in the rearview mirror for the Fed?
I think that's absolutely correct.
Really?
When you look at the factors that make up, inflation with regards to shelter,
then he mentioned shelter being the sticky
point. What about
energy? Yeah, $80 oil.
Look, I think the incoming administration's plans are to ramp up production by at least over 3 million barrels a day. That's going to be something that's going to cause crude oil likely to fall down to 50, potentially 40. That's my target. So I'm actually underweight energy for the year. I don't think that's going to be a big deal. That's going to cause further disinflationary pressure. And I think China is something that nobody's talking about. I mean, they're entering a time when it could be a very deflationary time, not unlike Japan was in the 90s. Their interest rates are down 300 basis points below Treasury yields. So that's something that they're going to need a lot of stimulus to be able to help their economy recover. Those are factors that are going to offset any potential tariffs being inflationary, in my view.